Bitcoin's not skyrocketing. It's been going sideways for years. But first of
against
all,
the real.
You don't live in Iran, so it's kind of irrelevant to you. But yes,
I don't think it's irrelevant to the people that are in the situation right now.
But you don't have to use Bitcoin. There are lots of other cryptos that you could use. And in fact, the best thing to use would be a stable coin. And there's plenty of those that you could get into. And in fact, the best stable coin, I believe, would be a tokenized gold. So I would much rather, if I was living in, Iran, and I wanted to transact, kind of anonymously through an app on my phone, and I had a choice between buying tokenized gold, buying a token that's stable and backed to the price of gold, versus just buying Bitcoin, which could go anywhere and is backed by nothing.
Why am I paying 0.5% for an ETF that's going to just buy me Microsoft, Nvidia, and I'm not comfortable about these valuations when I can go buy for myself 5 silver stocks that are hemorrhaging dividends?
Well, not just gold and silver, but gold and silver have been around for thousands of years. I mean, they survive everything. But look, copper, nickel, lead, zinc, all these metals are going up. Commodities, agricultural commodities are going to go up a lot. Energy, oil has been cheap. It's about to get a lot more expensive. Look, when you have a currency crisis, real things maintain their value. Commodities that have a use maintain their value. Assets that produce real income maintain their value. And so farmland, income producing property, companies that generate a lot of income and pay a lot of dividends. These are real tangible things that maintain their value when paper is blowing up, right? And so that's what's going to happen. But see, like a Bitcoin is very similar to just paper, because Bitcoin's only use is to gamble on appreciation. You buy Bitcoin because you think the price is going to go up. And you think the price is going to go up because you think somebody else is going to pay more than you did. And they buy it because they believe the same thing. Everybody believes there's a greater fool who's going to pay a higher price. But while you're holding your Bitcoin, it doesn't generate any income. It doesn't pay interest. It doesn't pay dividends. You can't do anything with it. You can't eat it. You can't use it to power, your house or your car. I can't make anything out of it. So all I'm doing is holding it, hoping the price goes up. And those are the kind of assets that could collapse in value in the environment that I think is coming.
Bitcoin, unlike physical commodities, is primarily a speculative asset. Its value depends on finding a greater fool willing to pay more. It generates no income, no dividends, and can't be used for production, energy, or sustenance. In contrast, mined gold converts energy into a universally usable asset with industrial, financial, and cultural utility. While Bitcoin has a role in currency-restricted regions, tokenized gold offers a more stable, intrinsically backed alternative. Real cryptocurrency should be tied to something tangible like precious metals, rather than relying purely on speculative demand. Stability and usability distinguish true wealth from digital gambling.
Bitcoin's not skyrocketing. It's been going sideways for years. But first of
against
all,
the real.
You don't live in Iran, so it's kind of irrelevant to you. But yes,
I don't think it's irrelevant to the people that are in the situation right now.
But you don't have to use Bitcoin. There are lots of other cryptos that you could use. And in fact, the best thing to use would be a stable coin. And there's plenty of those that you could get into. And in fact, the best stable coin, I believe, would be a tokenized gold. So I would much rather, if I was living in, Iran, and I wanted to transact, kind of anonymously through an app on my phone, and I had a choice between buying tokenized gold, buying a token that's stable and backed to the price of gold, versus just buying Bitcoin, which could go anywhere and is backed by nothing.
Tokenized gold bridges the gap between digital convenience and tangible value. Platforms like T-Gold are enabling users to hold and transact gold-backed tokens efficiently. Transactions are faster, cheaper, and more predictable than Bitcoin, offering real utility without the volatility of speculative cryptocurrencies. For individuals in high inflation or restricted currency regions, tokenized gold provides a reliable medium of exchange. Unlike fiat-backed digital currencies, these tokens retain intrinsic value. As adoption grows, gold-backed digital assets may become mainstream, providing a secure alternative for wealth preservation while maintaining the benefits of digital finance, speed, accessibility, and security, without losing the inherent value of real commodities.
I would much rather have gold to use. So, Bitcoin is just one token, but there are thousands and thousands of other tokens that could be used instead of Bitcoin. And there's much better tokens if you get it backed by something. I'd rather have something backed by something. Like if I'm going to use paper currency, I'd rather have paper currency backed by gold than paper currency backed by nothing, right? Fiat currency is not as good as legitimate currency. Bitcoin would be a fiat cryptocurrency. I'd rather have real cryptocurrency. I want to have a cryptocurrency backed up by real money. And that can do exactly the same thing. In fact, and I'm going to be setting this up myself too, at T-Gold. People can go to tgold.com and set up an account with me. We're going to be tokenizing gold. But the tokens that we're going to create, to the extent that people want to withdraw them, it's going to be a lot cheaper to transact in those tokens than in Bitcoin. And the transactions will happen much faster. Bitcoin can be very slow, especially, if more people actually want to use it. But fortunately, fewer people are going to be using it. So maybe the cost will go down. But when you want to talk about, who's ignorant, I mean, you just mentioned that you're 23 years old and, you're only 23, your life experience is somewhat limited. You will be a lot wiser with a lot more experience when you're 33, when you're 43, when you're 53, or when you're 63, like me. And so if one of us is ignorant or missing something, it's more likely that it's you.
Commodity markets are heavily influenced by speculation, particularly leveraged retail traders. When margin requirements rise, leveraged buyers are forced to reduce positions, suppressing price momentum. Sellers, including miners and industrial producers, respond to higher costs by delaying forward sales, reducing supply and intensifying upward price pressure. ETFs exacerbate the concentration of capital, favoring large liquid assets while starving smaller, undervalued opportunities. Understanding market mechanics reveals that price swings are not solely retail-driven. They reflect strategic decisions by large commercial players managing production, hedging, and capital efficiency. These forces combine to create periods of rapid price spikes after long cycles of suppression.
That is a Michael Saylor a talking point. Bitcoin is not energy. You need energy to solve the mathematical equation that results in a Bitcoin. But the Bitcoin itself is not energy. The energy is gone when you get to Bitcoin. Now, like in contrast to gold, if I mine gold, I use energy to mine gold, just like you use energy to solve a math problem to create a Bitcoin. But after I've expended that energy, I have now dug up an ounce of gold and I've put it into a form where it can be used. It can be used by all sorts of industries that need gold. And it can be used by central banks that need gold, by investors that need gold, by jewelers who need gold. And so I've turned energy that has value into a precious metal that also has value. I've converted energy to metal. But when you use energy to solve a problem to create a Bitcoin, you've wasted the energy, because at the end of the day, you have nothing. You have a worthless string of numbers that can't be used by anybody. The only thing you could do with Bitcoin is give it to somebody else. But that doesn't count because they can't do anything with it either, except give it to somebody else who also can't do anything with it.
Industrial users and miners, known as commercial players, act differently than retail speculators. They prioritize cost efficiency, holding production until prices justify immediate sales. By selectively releasing supply, they influence the market's offer stack, amplifying scarcity and fueling price rallies. Strategic withholding can squeeze over-leveraged speculators, forcing higher bids and creating rapid upward moves. This interplay between supply-side discipline and speculative demand explains the sudden parabolic surges seen in metals like silver. The market isn't random. It's a structured tension between those producing real commodities and those attempting to profit from short-term swings, ultimately rewarding patience and real value.
The Benjamin Grahams, the true Benjamin Grahams, the descendants of Benjamin Grahams, will be massive buyers of silver. And eventually Warren Buffett himself won't be able to ignore it. But right now, he's like, oh, it's a rock in the ground, dug up out the ground and then put somewhere else in the ground. Well, actually, you were the cash flow guy. You were the low PE value-based investor guy. You were supposed to be. You studied at Graham's knee. So eventually the value investors will be wailing in there and resource will get its recognition. But you've got to realize we've had 2.5 decades since the dot-com and the run into the dot-com. You can take from 96 even, Cisco, all of it. And into that boom. And then we had a little bit of housing when it wasn't going so well, back into the boom. They've trained an entire generation and they've created a vehicle. Don't underestimate the role ETFs have done with weighting by market cap. They keep adding more money onto the ones that have already got big so that the big get even bigger. And that starves money from the ones that have been ignored and they get smaller generally until the news and the noise they're making in terms of outcomes far exceeds the other things. Then you get people going, hold on, why am I paying 0.5% for an ETF that's going to just buy me Microsoft, Nvidia, and I'm not comfortable about these valuations when I can go buy for myself 5 silver stocks that are hemorrhaging dividends.
After decades of suppression, gold and silver are poised for recognition. Value investors, guided by traditional metrics of cash flow and industrial utility, are returning to these metals. ETFs and speculative instruments created artificial distortions, but rising industrial demand, strategic withholding, and a crisis-driven appetite for tangible assets are reshaping the market. As scarcity meets real-world need, these metals are likely to experience sharp appreciation. The next wave of investors, from legacy value strategists to cautious individuals, will finally drive prices to reflect true utility. Gold and silver are reclaiming their role as foundational wealth assets in a volatile financial world.
And it's counterintuitive entirely. It depends what kind of run you have. So when you had sort of Wall Street silver chase and it's all small retailers all taking leverage and buying and hitting the stack, what you have is a speculator with leverage-based boom. And the way you kill a speculator with leverage-based boom is your up margin requirements. So the main mover of the market is the speculator who's been given too much leverage or has managed to get access to any amount of leverage, and you make that leverage more expensive, less available, and much more capital down. You do those 3 things. It's the same as house prices. If you have to put more money down, the interest rates are going higher, which we're predicting, by the way, with the debt-based collapse. You can afford to pay less. You can't chase for that house, and prices come down because everybody else that's relying on a mortgage is in the same boat as you. That's how you cull and take the knees of a speculative with leverage, retail-driven market. Now you've got to ask, is this market that market? A retail speculator with leverage markets? No, you and I might be doing that, but we're the sideshow. We're ants. This is major industry physically demanded market. So what's different about that, and what is the net effect of that? Well, what it happens is when you increase margin, the way the futures market work is the buyer has to put more margin down and might pay more interest for the lesser margin that he gets to run in and whale in. But the same applies to sellers who do sellers contracts. You might say, okay, but why is that a problem? That means they're less selling. No, the mines sell in the futures market, and it goes up by day, the cost as well. So the longer they're in, the more it costs them to hedge, and they sell forward production. So when you increase the costs of them forward selling their production, and by duration as well, they say, well, we'll hold off a little longer. We're saving some money by not forward selling, and the price in the market is pretty good, as you can imagine. So they then don't bring it as soon, and they don't do it for as long, and it reduces supply of producers, which is the miners, making available because you push their costs. Remember, they have an accountant and a treasury that will be looking at this and go, They made it more expensive for us to go there and sell it. And we sell it and we hold the contract until, for 3 months. Why don't we just wait till the last week? You've saved a bunch of money by doing that. You've saved a bunch of money. And they're the ones that bring big contracts. You and I might buy one contract which has 5 by 1,000 industrial bars. Most retail, not buying 1,000-ounce industrial bars, by the way, in the futures market. I have, but most retail, 10 ounces, 100 ounces, maybe you get 100 ounce, from Scottsdale, and it's a nice little brick. People aren't buying the ugly as sin industrial use margin. So it's not retail that's actually pushing the futures price up. And if you make the cost higher, people will be more tight and delay offering that contract. So what actually happens is you're killing the offer stack. There's a bid stack. There's the midpoint where the trade is taking place and it's flickering along, a little bit up, a little bit down. And there's all the offer stacks. At that price, I'm happy to sell my forward production. Remember, markets are used not just for speculators. There's the commodity, the business interests, the operators. Though I'm trying to remember what the phrase is. I'm having a bit of a brain fart, but the industrials, it's the commercials, they call it. When you get the breakdown on retail, commercial, speculators, etc. The miners are the commercials. So they'll choose more selectively. And given the price market, they also don't need to rush. So why should they pay more to rush to do what for a long time, just to hit a rate when it's already deep in the money and possibly going deeper? They're in greed mode now, and they can hold off. So what it actually does is it reduces the offer stack. And then those that are squeezed and in a suppressed situation, think UBS, as if the story is true. We don't know. There's rumor, there's everything. We've always suspected certain banks are going to be hit, American ones, European ones. They now have to chase much higher to get a certain number of contracts closed. So they have to bid more aggressively. And that's why you're getting the parabola move. And you've got that 60-year of suppression all having to be made right very, very quickly. And you've gone and made it worse. You've poured fuel on the fire by making it expensive for suppliers.